Hello everybody and welcome back to Teachers Talk Money, where I help teachers master their money in order to give back to themselves. Today's video is based on a question that I get pretty often, and it's sort of a more focused question about investing and actually the practical pieces of investing. And this question is whether or not you should use a robo-advisor for your IRA. So let's break down what this actually means, what the alternatives are, and who a robo-advisor might be right for, and who should self-direct their investments instead. So first we need to get into the nitty-gritty of what is an IRA. This stands for Individual Retirement Account. I should probably say at this point that this advice is US specific because it's actually going to be different in different countries. And an individual retirement account, or an IRA, is a type of investment vehicle. You have probably heard of a 401k, or for teachers, 403b or 457b, and those are other types of retirement vehicles that you get through your employer. The advantage of an IRA is that anybody can open one, whether or not you have an employer who sponsors one of these other type of retirement plans. And you also potentially have more control over the funds that you choose within it and more control over the tax structure you want based on what kind of IRA you choose, a Roth, traditional, or something else. For more detailed information on this, I'm going to link my investment video below because it kind of explains the differences between those two types of accounts. But for today, we're just going to be talking about whether or not using a robo-advisor to choose the funds in your IRA is the best option. So a robo-advisor is essentially an algorithm that chooses different funds for you based on your risk tolerance and other investment choices. So the first thing that I want to say today is that the question of whether or not to use a robo-advisor or choose your own funds is really a smaller question in the grand scheme of things if this is something that is stopping you from opening that IRA account. The biggest wealth gaps when it comes to investing are caused by whether or not you actually are investing, not necessarily whether you're using a robo-advisor or self-directing. So if this question of whether or not to use a robo-advisor is what is keeping you from starting investing, then I recommend to probably just use a robo-advisor as a bridge to just get started and then continue to learn more as you go along. You can always adjust your investment plan, but it is very important to get started. So let's talk about who I would personally recommend a robo-advisor for. I personally believe that robo-advisors are wonderful for beginner investors because it takes away some of the necessity to look deeply into many different funds and decide which ones you want to be invested in and how many and all of that good stuff. They completely take the anxiety over which funds to choose out of the equation. I began investing with a robo-advisor and I actually am still using one, and I may end up changing that sometime in the future. But it was a really important step for me in just getting my money in the market in funds. Does this come with risk? Absolutely. Literally every type of investing comes with risk. Everything I'm going to talk about today, of course, comes with risk. However, this is still pretty risk tolerant because essentially what the robo-advisor will do for you is choose a couple different funds to invest your money in. And essentially what a fund is a collection of different stocks. So these are automatically more diversified than you picking and choosing individual stocks. And the reason that this is better is that if one company goes down or a couple companies in this fund go down, that does not mean that the entire value of the fund necessarily will tank. Again, if this concept is not making sense to you, please check out my investing video below. I go over this in a little bit more detail. So, in other words, if you want to get started investing but you're not totally confident in which funds exactly to choose, then I would begin with a robo-advisor. Now, a very important consideration if you are going the robo-advisor route, or really actually with any type of investing, is what fees are associated with that. So there's two types of fees when you're looking at investing. One would be a management fee or an advisory fee, and this is something that some robo-advisors have you pay. And the second level of fees are the fees that are associated with whatever funds you are invested in. So with a robo-advisor, you have to deal with these two layers, right? You might be with a robo-advisor that charges a 0.25% management fee, And then whatever funds it chooses will also have fees associated with them. And because it's choosing them instead of you choosing them, you don't have as much control over how much you're paying in those fees. I personally use SoFi as my robo-advisor, and I like SoFi because they do not have any management fees. So the only fees I am paying are those associated with whatever funds that SoFi chooses for me. Now, I think fees are a very important thing to consider with investing when you get into investing more and more money, or when you get later and later in your investing journey. And that's because those small numbers, like 0.25%, can add up to be hundreds of thousands of dollars when it comes time for you to actually take that money out for retirement. And so they are very important things, and I don't want to undermine it. However, once again, if you're just getting started, and we're not talking about putting a ton of money into the market, those fees are going to be very negligible to start. And like I said, you can always adjust your investing plan after you take that initial step of just getting your foot in the door. So now let's talk about the opposite. When is it a good idea to not use a robo-advisor and to self-direct your investments? This is a great option when you understand the ins and outs of various funds and you're confident in choosing funds to invest in. A lot of do-it-yourself investors actually just choose one fund to invest in, usually a total stock market fund or the S&P 500 or something of that nature that has a large collection of a lot of different companies and has low fees associated with it. Again, you might be saying, isn't it dangerous to have just one fund because that's not diversified? But the reason that a lot of investors do this is because, like I said, it is a fund with many different companies in it. And so in a way, it is automatically already diversified just in terms of what it is. So once again, I just want to emphasize that all types of investing carry risk, whether you're using a robo-advisor or completely DIYing your investment portfolio. However, I don't want this to scare anybody because I truly believe that it is still more risky not to invest. And that is because if you are keeping your money in a checking account or savings account, you are actually most likely losing money each and every year due to inflation. Which means that investing in the market where you can get a higher rate of return is pretty much the only way to grow your money. Of course, there's other types of investing like real estate investing and things like that, but my point remains that it's more dangerous not to invest your money. So in summary, I like low or no fee robo-advisors for those beginners who are not confident choosing their own funds. Again, the biggest gaps in wealth are from investing versus not investing, not between those who use robo-advisors and those who create their own portfolios. So getting started is the most important step. However, once you learn a little bit more about the ins and outs of different funds and you feel confident picking one or more funds yourself to invest in, you can then avoid a lot of money in fees because you don't have to pay a management fee and you can choose funds intentionally that have very low fees associated with them, which could make a huge difference in the money that you end up with in retirement. I hope this video was helpful. Please comment down below if you have any questions. I know that investing can be a really hairy topic, and as always, I should probably remind you I'm not a financial advisor, and that's why I'm giving much more generalized investing advice, but anyone should seek advice on their particular specific situation because it is going to be different for everyone. I hope you enjoyed this video, and I will see you guys the next week. Bye!